Hello and welcome to another in our series of broadcasts to bring you news and views from Deloitte. My name is Robert Bruce and I am a financial journalist. As you're all aware, the IASB recently issued its much anticipated new revenue recognition standard, IFRS 15, Revenue from Contracts with Customers. With me today to discuss in depth some key issues that you may experience when considering the impact on your business are Phil Barden and Amy Haworth. They both work in the UK IFRS Centre of Excellence and have been part of the team monitoring the revenue project. Phil, the release of this new standard has been a long time coming, and throughout its drafting, it's gone through multiple revisions. Can you just give us a brief history of its development?
Yes, absolutely. There is a lot of history here. This project's been running for more than 10 years, and actually it's a joint project between the IASB and the US standard setter, the FASB. And they both felt that they needed to change their existing revenue guidance, though for quite different reasons. The IASB had IAS 18 and IAS 11, and not a lot more than that really. But the guidance in IAS 18 in particular was thought to be very thin in some key areas. So we're going to talk later on about a concept called unbundling, which is very important for revenue recognition. Actually, there's virtually nothing on that topic in IAS 18, and that's seen as a major deficiency in the standard. The situation in the US was completely different. In the US, they had an awful lot of revenue standards, and they often had very detailed guidance in them. But conceptually, they weren't necessarily consistent with each other, so different judgments had been made in different standards, and that was felt to be a flaw of that system. So both boards felt that they needed to make a change. Now, you might think, oh, well, perhaps it took a long time to do because they didn't agree with each other. Actually, that's not the case. They have largely agreed with each other all the way through. The real reason it's taken a long time is because it's been quite difficult to do. So actually over that 10-year plus time period, we've seen one discussion paper, we've seen 2 exposure drafts, and then the final standard, and we've had some other consultations along the way. But what we've seen is that some of the topics covered have changed quite significantly from one set of proposals to the next, because they've spent more time thinking about them. They've had to come up with some important concepts pretty much from scratch. What we've got though at the end of this process is an IFRS and a US standard that are pretty much fully converged. The differences between them are really very small indeed.
Amy, now that it has been published, what exactly are we looking at?
Well, Robert, IFRS 15 is essentially a 5-step model that is underpinned by some core principles. It has significantly more guidance on issues that we've previously encountered, whereas IAS 18 and the related standards had relatively little or no guidance. In some areas, applying that guidance will be quite judgmental, but in other areas, the guidance is relatively prescriptive. At a high level, step 1 is about identifying a contract with the customer, both the conditions for something to qualify as a contract and guidance on when you might need to combine those different contracts. Step 2 is about identifying the different goods and services that should be accounted for separately. These are called distinct performance obligations, and people sometimes refer to this stage as unbundling the contract. Step 3 is about identifying the transaction price, which is the total amount to which the entity expects to be entitled. In other words, the amount it will ultimately bill. This step has guidance on when you are allowed to factor in the amounts that are uncertain. Step 4 takes that total amount and tells you how to allocate it between the different performance obligations. Then, Step 5 tells you when to actually recognise the amounts of revenue allocated to each distinct performance obligation. There is guidance on whether that allocated revenue is all recognised at a single point in time, or, alternatively, over a period of time. The standard has also included implementation guidance on a range of issues. Among these are issues such as the sales with rights of a return, warranties, licensing and bill and hold arrangements. And it also introduces some new extensive disclosure requirements.
Now I know IFRS 15 has an effective date of 1st of January 2017. This is quite a while away. Why are the boards giving everyone so long before implementation?
Well, the short answer is that some companies are going to need that long in order to cope with adopting the new standard, and that's for several reasons, but probably the most significant amongst them, as we'll talk about a bit more later, some companies are going to need to change their IT systems in order to comply with the standard. And actually, even where that's not the case, companies will need to think about the processes that they have for tracking down information for disclosures. And they will also need to track down some information about older contracts that are still ongoing in 2017, because they'll need that information in order to actually apply the standard. So for some people this is going to take a long time. For other people it may be a slightly smoother process. They are allowed to adopt the standard earlier than 2017 if they want to.
So it sounds like systems and transition might be a key issue for businesses to start thinking about. Apart from this, what are the really key areas of impact that businesses should also be thinking about?
So that's actually quite a difficult question to answer in the context of this standard. I think the impact is going to be very entity specific, and what we're going to see is that some of the new guidance that represents a small change for some people is going to be a big change for other people, and that's primarily because we are moving to quite a new detailed standard from something that was really quite thin. So there was quite a lot of room for judgment before. So what we now have is a lot of new and detailed guidance where previously there wasn't guidance, and we also have some important changes compared to previous guidance that did exist. So we're going to talk over the next hour or so about some of the more significant changes, but I think the really important message here is this. Previously, when you were applying IAS 18, IAS 11, you were making some judgments in areas where there was no detailed guidance. You were making reasonable judgments, but they may no longer be okay. They may no longer work under the new standard. So really, there is no substitute for an individual entity sitting down and analysing what this standard means for them. Now, I would say that there are three separate things to think about. I think there is a real danger that some companies are going to underestimate this standard and only realise the real impact for them relatively late in the day, which will be a challenge. So obviously for some people we're going to see a significant change to the timing of revenue and profit. And obviously if you're in that camp, you're probably already thinking hard about this standard. But don't feel secure merely because you are not expecting that to happen to you. The impacts are not just about timing of revenue and profit. As I mentioned a moment ago, there are also potentially impacts on systems and impacts on processes. And don't underestimate pulling together disclosures as well. That's potentially going to be quite a bit of work.
The new revenue model is made up of a series of steps. So let's start from the beginning. Amy, I understand step 1 is about identifying the contract. Can you provide us with some more detail on this?
To start with, identifying the contract is determining whether you actually have a contract with a customer that meets the recognition criteria of IFRS 15. There are 5 criteria that must all be met in order for recognition. These are that the parties to the contract have approved the contract, that the entity can identify each party's rights regarding the goods or services to be transferred, that the entity can identify the payment terms for the goods or services to be transferred, that the contract has commercial substance, and that it is probable that the entity will collect the consideration to which it will be entitled to in exchange for the goods or services that will be transferred to the customer. This last requirement refers to collectability and inserts a threshold that hinges on whether collectability is probable. An assessment will need to be done of the customer's ability and intention to pay the amount of consideration when it is due. It is worth keeping in mind, however, that when we refer to consideration, IFRS 15 states that this is the amount that an entity expects to be entitled to, and therefore may actually be less than the stated contract price. We will discuss this concept in more depth in step 3, determining the transaction price.
So, if a contract with a customer does not satisfy all those criteria, then they cannot recognise revenue by applying the framework. What should entities do if they are receiving payments from customers under these agreements, even though they do not meet the recognition criteria for a contract with a customer?
Well, the short answer is that they should wait. They should take the amounts that they've received and treat those as deferred income. Often this is just a question of timing, it's a question of waiting until the criteria are met. Now, there might be a few unusual cases where the criteria are never met, and we do have some specific rules for those scenarios. And broadly, it's that no revenue gets recognised unless two things are true. One is that the amounts received from the customer are non-refundable, and the second is that all of the performance under the contract is complete.
Step 1 also has some guidance on contract modifications.
It does, and there was no previous guidance on this topic, whereas the new guidance is actually fairly prescriptive. So this is another important issue. Again, this is potentially going to be a systems challenge for some entities. It's actually easiest to understand how to deal with contract modifications after getting to grips with the 5 steps. So we're going to come back to this later as part of the other considerations section of this talk.
Now let's move on to step 2. This step requires businesses to identify the separate performance obligations in a customer contract. Amy, how is this different, if at all?
Well, Robert, IAS 18 previously had no guidance on how to identify separate performance obligations, whereas IFRS 15 now has a great deal more on this. Nevertheless, we expect the new guidance will sometimes be quite judgmental and tricky in practice to implement. To apply this, IFRS 15 makes you go through a series of steps. The first step is to identify in your contract what promises you have made to transfer goods or services to customers. The next step is to determine which of those promises to transfer a good or service represents a distinct good or service. The broad idea of something being distinct is that it could have some value in its own right. When determining if a promise to transfer a good or a service is distinct, there are 2 criteria that must be met. The first criteria is that the customer is able to benefit from the good or service either on its own or together with other resources that are readily available to that customer. This is looking at whether the item is capable of being distinct. Could it ever have value in its own right? The second criteria is that the good or service is separately identifiable from other promises in the contract. This is looking at whether in the context of the contract, the good or service is actually distinct. Does it seem to be something valuable in its own right as part of this contract?
And how do we determine what is separately identifiable?
Well, there are several factors that will need to be considered when assessing the second criteria of separately identifiable. Are you providing a significant service of integrating the good or service with the other goods or services promised in the contract? If you are, that suggests that the good or service is being used as an input to produce or deliver the combined output required by the customer. In other words, the item doesn't have value in its own right. It only has value as part of something bigger, that is, the integrated item. Alternatively, does the good or service significantly modify or customise another good or service promised in the contract? If it does, again, this suggests that the value for the customer is in the modified or customised item, not separately in the original item and the service of modifying or customising it. Is the good or service highly dependent on or highly interrelated with other goods and services promised in the contract? If so, maybe that suggests that these items should be combined. To test whether this seems to be the case, you could hypothetically ask, if the customer did not purchase the particular good or service, would it have a knock-on effect on their purchase of the remaining goods or services? Now, if a promised good or service is not distinct, then you combine that good or service with other promised goods or services until you can identify a bundle of goods or services that is distinct. In some cases, this may mean that all the goods and services promised in a contract may be accounted for as a single performance obligation.
Phil, this all sounds quite lengthy and judgmental. As a result of this process, do you expect businesses will actually have a change in the number of performance obligations they might identify under the new guidance?
Yes, definitely there will be some changes. Best practice before was probably based on an idea of standalone value, and that idea has a certain amount in common with what we see in IFRS 15, but there are some definite differences. Probably worth talking about a few examples here. So one of the classic examples that the IASB has used in its literature is the example of a telecommunications company providing both a handset and a package of network services. And so the question here is, should the handset be unbundled from the provision of network services? Now, usually the answer is going to be yes, because usually the handset will have value in its own right. It'll be capable of being used with another provider rather than just this provider. And actually, when you look at how the contract works as a whole, the services received from the network, they're not going to modify the handset. They're not highly interrelated in the sense that the one could only be used with services from this particular supplier. So you're probably going to find that you tick all the boxes for unbundling. Another important example is software. Now, it's quite common for a software company to have a sort of standard license product, but to supply that as part of a package with some other services. And so the question becomes, can you unbundle the license from those other services? And actually, the answer is going to be different depending on what those services are. So very often services will include things like ongoing support and maintenance. And usually those are the kind of thing that even if you didn't get them, you would still have a working product. So actually, probably we would expect that they would typically be unbundled. At the other end of the spectrum, sometimes those services are actually to take the license and significantly modify or customize it so that it's turned into the product that the customer really wanted. And it's fairly clear that if that's the case, that you're not going to pass the second stage of the unbundling test. And that's so even if that modification or customization service could have been provided by a different supplier, because you'd get through stage one of the tests, but you wouldn't get through stage two, because at the end of the day, what the customer wants is the modified thing, not the core software. Now, one other aspect of this that's worth drawing out is the scenario in which businesses charge upfront fees. And we see this with things like health clubs and various other bodies. And sometimes they have historically taken those upfront fees as revenue when they are invoiced. And sometimes the justification for that has been that those fees are to cover administrative and other costs that are incurred at the start of a contract. There's a very clear message in IFRS 15. That's not going to be appropriate unless you can show that there is a distinct good or service that's been delivered at the very beginning of a contract. So, for example, for a health club, merely incurring some admin cost at that stage, that's very unlikely to constitute a distinct good or service. So you would expect instead that those fees would be spread over the life of the contract and not recognised up front. So we've talked a little bit about unbundling. Overall, I would say this is one of the most important areas for companies to consider. It can have a very significant impact on timing. As we saw with the software example, it's the difference between having a big chunk of revenue right at the beginning when you hand over the license, or not having any revenue at that point in time at all. And it might be quite judgmental in some cases. The second step that Amy described, that's going to require a bit of thinking about from time to time. And it may be that the answer is rather grey rather than completely black and white. So potentially very dependent on facts and circumstances.
Now let's talk about the third step, determining the transaction price. There was a lot of discussion amongst the boards in relation to this after the release of the second exposure draft that has made it into the final standard. Amy, can you please take us through what this is all about?
Yes. This step requires an entity to determine the transaction price of the contract at the outset. In other words, you need to estimate the total amount that the customer is ultimately going to be obliged to pay. This price will then be allocated to the performance obligations in step 4. When actually determining what your transaction price is, there are a number of things that you will need to consider, but it is easiest to think of them as falling into 2 overall categories. The first category consists of guidance on how to estimate the total price. The second category consists of guidance on what to do if there is significant uncertainty over what that total will eventually be. To start with, your transaction price is defined in IFRS 15 as the amount of consideration to which an entity expects to be entitled in exchange for transferring promised goods or services to a customer. This amount may be affected by a number of things, such as variable consideration, the constraint around estimates of variable consideration, and the existence of a significant financing component, to name a few. So, focusing on the definition, what an entity expects to be entitled to should take into account the terms of the contract and the stated price, along with customary business practices. For example, if it's customary for a business to give a 10% discount off the contract price for a customer, then the amount that they can expect to be entitled to is 90% of the stated contract price. But remember, for the amount that an entity expects to be entitled to, the customer's credit risk is not usually taken into account. There's one exception to this, which we'll come back to shortly. As I mentioned earlier, you will also need to think about variable consideration. If the contract contains a variable amount, this must be estimated by the entity. As you can see from the examples of variable consideration, which can be seen on this slide, it can be quite wide-ranging, and entities will have to think carefully about these elements of their contracts.
So variable consideration has actually been one of the trickiest issues for the boards to think about. They put out one discussion paper, 2 exposure drafts, and then the final standard. Each time they published something, the guidance on variable consideration was different. Now, why has it been so hard? I think it's because it's not just about making the best estimate of where you're going to end up. You also have to consider uncertainty, and that's where they've had to come up with some new ideas, some new concepts. If you sort of step back for a second, it seems fine to include some variable consideration if it's not too uncertain. But then at the other end of the spectrum, you've got some variable consideration that feels very uncertain. It doesn't feel safe to include that. Now, people sometimes talk about things as contingent fees. That's often a good example. There's probably a lot of uncertainty associated with them. So what the boards needed was to find a way to exclude variable consideration if it was too uncertain. And what they've come up with is the idea of this constraint. So the constraint says that you can only include variable consideration if it's highly probable that there will be no significant revenue reversal when the uncertainty is resolved. But it's very important to understand this is not an all or nothing test. So suppose that you look at your total variable consideration and you think, yeah, I can't include all of that, I would not pass the test. Then you have to ask yourself, could I include a smaller amount of it? Would that pass? So that's going to need some careful judgment.
Will this constraint on estimates of variable consideration be applied to all situations?
No, it won't. The boards have built in one exception, which is for sales or usage-based royalties relating to licenses of intellectual property. Where you expect to receive royalties as a result of having transferred such a licence, you don't try to estimate in advance what those royalties will be. Instead, you will recognise revenue when the underlying sale or usage actually happens. The reason the boards built in this exception was because they decided that applying the constraint concept to royalty revenue from licences of intellectual property would be too difficult and too judgmental.
Now, this concept of the constraint on variable consideration sounds potentially complicated. Do you think it'll be so in practice?
Yes, I think it will be complicated for some. The impact is likely to vary for different industries, and it's going to be important to assess the right treatment of variable consideration at inception of a contract and then to reassess it at each reporting date. Now, I spoke about uncertainty a moment ago. This is very much a spectrum, so let's look at some examples from each end of a spectrum. So one example would be an investment manager. The investment manager may provide services for a period of time. At the very end of that period, they may have some kind of contingent fee. If they hit a particular target, they will get a large amount of money. If they don't hit that target, they won't get any of it. So if you think about it, that's something that's going to stay very uncertain right until the end of the process. And because it's a large number and all of it would reverse, there is the prospect of a significant revenue reversal. So chances are you won't be factoring those things in advance. You'll probably wait until you either hit the target or you don't, which is probably the same as practice at the moment. Now let's look at the other end of the spectrum, which is where you're constructing a property for somebody else. What you very often find is that there is a target date to complete that property and there's a contract price that will be payable if you hit that date. If you're late, you will start to suffer some penalties. If you're early, you may get a bonus. So actually, the total amount you're going to get is not fixed, it is variable depending on when you finish. But it's not as variable as the contingent fee in the investment manager case by any means. And it's also something that is much easier to predict. And actually, You won't end up exactly where you expected, but you probably will end up relatively close to where you expected. And of course, as you go along, you get a better idea of where you're going to end up. So in that scenario, you probably won't expect a significant revenue reversal, and it will probably be okay to keep using your latest best estimate of where you're going to end up. So I've looked at examples from each end of the spectrum. Probably this is not going to change practice at those ends. The challenge is going to be in the middle of the spectrum. That's where we might see a change in practice. So summing this up, this is a new concept. It's potentially fiddly, and it's going to need some care and some judgment, and it may be a bigger issue where you have long-term contracts. And I think it could change the profile of revenue recognition for some entities.
Now, long-term contracts were mentioned there. Amy, will there need to be consideration about the time value of money?
Yes, there will be. And there is actually a very important change here. IAS 18 previously only had guidance on the time value of money when a customer was making payments in arrears. IFRS 15, however, applies the time value of money to payments made both in advance and in arrears. Basically, if the timing of the payments agreed to in the contract effectively provides either the customer or the seller with a significant benefit of finance, then you will have to adjust the amount of consideration for the time value of money to strip out the effect of that financing component. The rate to be used will be the rate that would be used in a separate financing transaction between the entity and the customer at the inception of the contract. Once determined, this interest rate will not be updated. There is, however, a practical expedient available for entities, where the period between when an entity transfers the promised good or service and payment for that good or service is 12 months or less, then the entity will not have to adjust for the time value of money. If the entity elects to apply that practical expedient, they will need to disclose that fact.
So this is really a key difference from IAS 18, because where the customer pays in advance, significantly in advance, then you may have to unwind an implied discount there. So the amount of revenue you're going to recognise ultimately is going to be bigger than the amount of cash that the customer actually paid. And some people will probably find that counterintuitive. The logic, though, is because there's a significant financing component here, it's as though two things are going on. Step one is the customer lending you some money on which interest is accruing, such that by the end of that process you owe them more money than they paid you because it's increased by the interest. And then step two is you keeping that amount that you owe them. That's now the payment that constitutes revenue in the transaction. So that's the logic of unwinding a discount where a customer pays in advance.
Now, step 3 was about determining the transaction price. Step 4 is about allocating that price across the performance obligations. How is this done?
Well, this step is fairly mechanical. Where an entity has multiple performance obligations in a contract, the entity will allocate a portion of the transaction price to each performance obligation based on their relative standalone prices. Where the standalone price is not directly observable, you will have to estimate it. The standard suggests some potential methods, including an adjusted market assessment approach, an approach based on expected cost plus a margin, and a residual approach, although you are only allowed to use this last approach in limited circumstances.
Now, this was a topic where there were some different views during the development of the standard. Some people wanted more room for judgment on how to allocate the total contract price between the different goods and services being supplied. Others feared that that might be too open to manipulation. What we have ended up with is something that's relatively rule-based. Now, as rules go, this is not inherently controversial, but I think it may create some practical difficulties. Let's go back to the example of a telecommunications company, which we mentioned earlier. They may sell a lot of different handsets. They may also have a lot of different packages of network services. The pricing of both the handsets and the packages may change quite frequently. Discounts may be very common. So if you ask yourself the question, how many unique combinations are there of products and prices, it's a very, very large number. And in theory, you need to do a separate calculation for each of those. Now, you almost certainly can't do this manually. The standard does allow a portfolio approach to be taken, but the question is whether this can be made to work both practically and with sufficient precision. And if not, then you need a systems solution. Can your systems cope with this degree of complexity, or actually are some systems changes going to be needed?
And now we get to the last and final step, recognising revenue. This is one of the most important things to businesses, when they can recognise their revenue and the pattern of it. And this is also potentially one of the biggest areas of change if a business is affected. Amy, what are the changes that people should be concerned with here?
Under IAS 18, different rules of revenue recognition were applied, dependent on whether the customer was purchasing a good or a service. Now, IFRS 15 introduces a single model of when you recognise revenue over time or at a point in time, and this model applies to all scenarios and is based on the transfer of control. Control in IFRS 15 is the ability to direct the use of and obtain substantially all of the benefits of an asset. It also includes the ability to prevent others from directing the use of and obtaining the benefits from the asset. Under the IFRS 15 model, you first have to look at the criteria for recognising revenue over time. If you meet them, then the standard suggests methods for how to do this. But if you don't meet those criteria, then control is not transferred over time, it is transferred and therefore recognised at a point in time. In order to recognise revenue over time, there are 3 different criteria and it's sufficient to meet any one of them. Firstly, the customer simultaneously receives and consumes the benefits as the entity performs. This means that if the entity was to leave the contract halfway through and a new provider was brought in, the new provider would not need to re-perform the work already completed to date. But you have to assume that the new provider wouldn't get any access to the work in progress that's controlled by the current provider. A cleaning contract is a simple example of this. Secondly, the entity's performance creates or enhances an asset that the customer controls as it is created, such as work in progress. For example, if you are constructing a building on your customer's land, the chances are that the customer will own and control that work in progress. And thirdly, the entity's performance creates an asset with no alternative use, and the entity has an enforceable right to payment for work completed to date. When considering this no alternative use concept, entities must consider both contractual limitations and practical limitations, such as the economic cost to redirect the asset for another use. As I mentioned before, if control is not passed over time, then it is passed at a point in time. When this is the case, then the entity must consider at what point in time the control is passed, as this is the point at which the entity will recognise the revenue. IFRS 15 provides several factors to consider when determining at what point control is passed. These include, but are not limited to, having a present right to payment, the customer having legal title to the asset, physical possession of the asset has transferred to the customer, the significant risks and rewards associated with the asset have been transferred to the customer, and the customer has accepted the asset.
So we've got 3 tests here for when revenue might be recognised over time, and if you pass any one of them, that's sufficient. I think the wording for all of them is a bit difficult to get your head around, but the first 2, once you've understood them, are relatively straightforward. So you've got an example of cleaning services where it's obvious that the customer gets benefit as you go along. Something's already been cleaned. You've got the example of something being constructed that the customer owns as it's being built. So those are not too hard to understand. The third one is the tricky one. It can be difficult to understand and there is a lot of detail in it. Now there are 2 key concepts in here which Amy was talking about. One is the concept of no alternative use. The other is the concept of an enforceable right to payment. Let's say a little bit more about each of those. The idea of no alternative use is that you are making this thing very specifically for this customer. Now that might be true because practically you wouldn't be making it for anyone else because, for example, it's something that only this customer would want. Or it could be contractually the case that you're making it for this person. And a good example of this would be an apartment in an apartment block. Actually, you could probably sell that apartment to lots of different people if you weren't contractually restricted, but the customer's contracted with you to get that particular apartment. That's the one they want. It's not okay just to give them a different one. So that's the idea of no alternative use. The idea of an enforceable right to payment is that if you are rightly going to see this as the provision of a service over time, then the customer ought to be on the hook to pay you for the work you've done so far. So that's the thing you're really focusing on. If the customer was to try to walk away, would they have to at least pay me for the work I've done so far? Now, it's not enough just to be compensated for any loss that you might make if they walked away. They need to actually be obliged to pay you broadly the pro rata amount that reflects the proportion of the work that you've done so far. And there is a certain amount of guidance in the standard on how to apply that, how to think about scenarios in which the customer actually apparently isn't allowed to walk away, whether that's actually the case. And you may actually have to look quite carefully at things like the legal environment in which you're operating in order to have a view on this. So at the end of this process, you have decided whether you are recognising revenue at a point in time or over time. And of course, previously people had goods and services and they recognised goods at a point in time, services over time. For a lot of people, once they've done this analysis, they will not be moving from one camp to the other. So they were goods before, now they're point in time. They were services before, and now they're over time. But there will be some for whom this changes. So there will be some people moving from point in time to over time and vice versa. And if that's the case, then this is going to be one of the biggest changes for them, because quite clearly the profile of revenue recognition is going to be completely different. So particularly for those entities with long contracts, this could be very serious, and it's going to be important to consider very carefully the terms of contractual arrangements. Now, I would particularly emphasise the guidance on enforceable right to payment, because it's not enough that you just have an enforceable right to some payment, it needs to be commensurate with the work you've done so far. So actually your contract terms on that, quite small changes in those contract terms could put you one side of the line or the other, and that could have a very dramatic impact on timing. There's one other thing we should talk about here when we're thinking about whether revenue is at a point in time or over time, and that is a new concept relating to licenses. What the boards are saying in IFRS 15 is that there are some licenses that transfer rights at a point in time, which would usually be at the start, whereas others are promises to provide access to some intellectual property over a period of time. Now, there is some quite detailed and quite fiddly guidance in the standard to help you work out whether you are in the point in time or over time category. Very broadly, and slightly surprisingly in some ways, provision of software, you'd almost certainly be point in time, maybe with some point in time updates, but you would be typically point in time. Licensing your brand, very likely you'll be over time. But there are some other scenarios that might be a bit grey and are going to need a bit of thought. So I'd emphasise this could be fiddly. This is something that if you are granting licenses of intellectual property, you'll want to look at this very carefully.
Going back to the new guidance on when control transfers over time, you mentioned that for some businesses this won't cause a change. But for those who will be affected, this will be the biggest change. Could you give us some examples of industries that might be affected?
Yes, absolutely. Now, I would stress that this is just examples of some industries that might be affected. I don't mean to imply that if you're not in this list, then you're not caught. But let's think about a couple. So I talked about apartment blocks a minute ago. Now, if you think about apartment blocks, they are typically to a fairly standard design. They are not individually specific to the customer other than at the level of relatively cosmetic things within the apartment. And previously we had some explicit guidance in IFRS that meant that you didn't get revenue recognition over time unless you were building something to the customer design. So that meant that basically you never got recognition over time for apartment blocks. What we will see now is that it could go either way, because in terms of the no alternative use test, you will very probably pass it, because almost certainly your contract says which apartment you have to supply. It's not okay to substitute another one. So we're going to be focusing on the enforceable right to payment test. And as I was explaining earlier, depending on how your contract has been set up, you might pass that test, you might fail it. It's going to have a very dramatic impact either way. Now, I'd say the other type of business that really wants to watch out for this is contract manufacturing. So you are a business that makes a particular product and you only make it for customer X. Maybe that's because only customer X wants it. You may previously have looked at this and said, well, I make these things over and over again and I supply them in large quantities and they look like goods, so I think they're goods. You may have looked at them and said, well, actually, in effect, I'm doing this to customer specification. In effect, they are designed for the customer. There are a lot of them, but they are to customer design, so maybe you were previously looking at this as revenue over time. Regardless, what you're going to need to look at now is, do you qualify for point in time or over time under the new standard? Now, once again, if you only make these things for one customer and you couldn't easily modify them very slightly so you could supply them to someone else, then you will probably have a practical restriction. And that means that you've passed the test of no alternative use. So it's all going to come down again to this enforceable right to payment. It's all going to come down to the contract terms, and I would particularly focus on what does the contract say happens if the customer decides they now want to cancel, they now don't want to take any more of these things. Do they have to pay you for the ones that you've part built, or are you on the hook for those? That's going to be a key point.
IFRS 15 introduces quite a bit of additional implementation guidance. Certain topics will be relevant to certain companies, and they could see some significant change in various areas. There are a few that we'd like to discuss today that may have wider consequences. Let's start with disclosures, for which IFRS 15 introduces a number of new requirements. Amy, can you please take us through what some of the new requirements are?
Robert, you're right that IFRS 15 introduces a number of new and different disclosure requirements, which is a big step up from previous GAP. In their deliberations, the IASB emphasised that the requirements are not a checklist and introduced a disclosure objective, which is for entities to disclose sufficient information to enable users of the financial statements to understand the nature, amount, timing and uncertainty of revenue and the cash flows arising from their contracts with customers. We expect that this may be challenging for many entities because of the detail required. Of note, there is now a requirement for a reconciliation between the opening and closing balances for receivables, contract assets and contract liabilities. An explanation of the significant judgments and any changes in these judgments that have been made in applying IFRS 15 and which affect the determination of the amount and timing of revenue. An aggregate amount of the transaction price allocated to those performance obligations that have not yet been satisfied, and an explanation of when the entity expects to recognise that amount. In order to ensure that these disclosure requirements can be met, entities will need to make sure that their systems are able to produce the relevant information.
When we were discussing the first step of identifying the contract, we noted that there was some additional guidance relating to what a business does when a customer contract is modified. Phil, what do we need to be aware of in relation to contract modifications?
So many businesses do actually allow their customers to modify their contracts. Some industries do this more than others. It feels like I've been picking on the telecommunications industry, but they are an example where contracts get modified quite frequently. So customers may increase their minutes or their data allowance. They may add additional services to smartphones. Now, the previous standards just provided no guidance on what you do when your contract is modified, whereas IFRS 15 provides some fairly detailed guidance. So what that means is that businesses will have been previously doing something that they thought was reasonable. It probably was reasonable. Now they're going to have to look at this detailed guidance, and that may cause them to change the way that they account for modifications. So there is a thought process to go through. First, suppose that the modification just adds some extra goods or services and the customer is going to pay an additional amount that is commensurate with the value of those goods and services. If you've got that situation, then basically you leave the old contract unchanged. You treat the extra goods as though they were a new separate contract, because after all, you're being paid a sensible amount for those new goods and services. If that's not the case, then things are going to be a bit more fiddly. And the key test that you have to apply is you have to look at what you haven't done yet, your remaining performance obligations, and ask yourself the question, are they distinct? So this is the idea from step 2. If they are distinct, then you will account for all of the changes prospectively. You won't have any kind of a catch-up adjustment to revenue. If they're not distinct, then you will account retrospectively and you will have some kind of a catch-up adjustment to revenue. Probably easiest to think about a couple of examples here. So let's think about construction of property first. Now, construction of a property very often is going to be a single performance obligation. So if you modify the contract part way through, then when you look at what you still have to do, that's not going to qualify as distinct because you are part way through a distinct performance obligation. And in that case, you will adjust retrospectively. So if you think of this as a sort of percentage of completion idea, then you will look at your new contract price, which has changed because of the changes, and you'll also look at the new stuff that you need to do and work out what's your new percentage of completion, and you're basically going to true up to your new contract price multiplied by your new percentage of completion. So at a point in time, you're going to get an adjustment to revenue. Let's contrast that with the telecommunications scenario where maybe you've added some additional services or you've extended the contract, you've changed your minutes, whatever. When you look forward from there, chances are all of the stuff that you need to do in the future could qualify as distinct. It's the kind of thing that somebody new could have come along at today's date and said, can I enter into contract for everything that hasn't happened yet? Yes, you probably could have done. That would probably be a distinct performance obligation. So in that scenario, you won't have any catch-up adjustment. What you will do is say, right, what is the revenue that I've not yet recognised, including any adjustments to what was previously agreed? And what are the goods and services that I've not yet supplied? And then, just as in step 4, you need to identify your different performance obligations, look at that total contract price, and allocate that price between these new revised performance obligations.
You mentioned before that businesses may encounter issues with their systems when implementing IFRS 15. Do you see contract modifications having an impact on this?
Potentially, yes. Now, not necessarily a very different impact from the impact that we discussed back at step 2, but you can see this being a logistical challenge if you've got an awful lot of different contracts, because as soon as you start modifying them, you've got even more different contracts, even more calculations to do. And of course, you've got to not only look at what amounts the customer is going to pay in the future and what you're going to supply in the future, but you've also got to take into account any deferred income or accrued income that's sitting in your balance sheet at the time of the modification, because that is going to adjust the future revenues that you are now reallocating. So if you have a very large number of different types of contract and then you're modifying them as well, that is again creating this scenario in which you've got so many calculations to do that you either need to find a portfolio approach or you need to think about systems changes.
The next subject I wanted to touch on was the guidance on how to account for those costs related to a contract. Amy, would you please take us through this?
Yes, but before I do, I just want to emphasise an important distinction. IFRS 15 has the guidance on the cost of obtaining a contract, that is actually getting the contract, and on the cost of fulfilling a contract, which are the costs of actually providing goods or services to the customer. The rules are different for each, so it's important to understand which one you're looking at. In particular, if you think about costs that are incurred before winning a contract, some of those may be costs relating to obtaining the contract, but others might be seen as costs that will ultimately relate to fulfilling the contract. For example, performing some design work in advance or building a prototype. Now, I'm only going to talk about the costs of obtaining a contract today. Most of these costs have to be expensed when they are incurred. There is an exception in IFRS 15 that requires entities to capitalise the incremental costs of obtaining a contract as an asset if there is an expectation that they will be able to recover those costs. But when it says incremental costs, it means something quite narrow, namely those costs that would not have been incurred if the entity had not obtained the contract. In other words, you always have to expense any costs that you would still have incurred if you tried to win the contract but failed. When an entity has capitalised these costs, they are then required to amortise the resulting asset. This will be done on a systematic basis that is consistent with a pattern of transfer of control to the customer of the goods or services to which the asset relates. This may require some judgment.
Phil, do you expect that this will be an area of significant change for people?
Yes, I think it will for some. Currently, I think there's probably a mix of different practices on which costs are being capitalised, whether costs are being capitalised at all. Now we have some fairly clear guidance on which costs have to be capitalised and which must be expensed. And obviously this is going to be a change for anyone who's previously not been accounting in the new way. Now, in some industries, it may not matter because the amounts may not be all that large, but there are some other industries where the amounts can be very large, and financial services can be an example of this. There is a practical expedient available, which is that if the amortisation period for these costs, if you had capitalised them, would have been a year or less, then you don't have to capitalise them, it becomes a choice. For everything else though, it's not a choice, it's a mandatory requirement. And actually if you take that practical expedient, you need to disclose the fact that you've taken it, and in fact that's true for all of the practical expedients in the standard. Amy talked about these costs once they are capitalised being amortised in a manner that reflects the pattern of transfer. The easiest way to think about this is if you know what your total revenue is going to be, then you ought to be amortising them pro rata to that revenue. Now, just to emphasise which costs get capitalised, basically this is success fees. So if the idea is that an amount only becomes payable because you won the contract, and if you didn't win the contract it wouldn't be payable, those are the ones that you capitalise. Pretty much everything else is probably going to be a cost that you would have incurred whether or not you were successful, and as a result it will have to be expensed.
Another important topic for consideration is the guidance around options to buy additional goods or services at a discount. Amy, what do we need to know about this?
So, customer options to acquire additional goods or services at a discount can come in different forms. Examples provided by IFRS 15 include sales incentives, customer reward points, contract renewal options, or other general discounts on the purchase of future goods or services. According to the standard, if the option to purchase goods or services at a discount provides a material right to the customer, then this gives rise to a distinct performance obligation, as we referred to previously in Step 2. The idea is that the customer has paid something for that option. It's a bit like paying a non-refundable deposit towards those future goods or services. Where this is the case, then the entity will need to allocate a portion of the transaction price to that performance obligation and defer recognition until either the right is exercised and those future goods or services are supplied, or the right lapses.
Phil, are there any examples you can provide us with in relation to this application?
Yes, there are probably two that are worth singling out, but I should emphasise that again, there's probably a load of others out there, and actually it's always going to be important to think about your own particular circumstances. But two I would single out. One is a very obvious one, which is customer loyalty programs. Now, we already have some guidance under IFRS on customer loyalty programs. We have an IFRIC interpretation that deals with them. The basic idea of that interpretation is to say that if you buy a package of goods, say from a supermarket, and you get given some loyalty points, which you can then use later on to get goods or services, then the total price you've paid is actually partly for the goods and partly for the loyalty points. So the idea is that you defer the amount that relates to the loyalty points. That gets recognised as revenue later on when the points are redeemed, and you actually supply the goods or services that you're claiming under those points. Not particularly a new idea that, but it's still in IFRS 15. The other example might be slightly less obvious. We talked about health clubs a moment ago. The example here is membership renewal rights for less than the original amount. Now, you might think, well, why would that apply to a health club? Because, you know, I join and then I pay the same annual fee in year 1 and in year 2 and in year 3. But actually, of course, what if you're paying quite a big joining fee? If you're paying quite a big joining fee, then we said earlier that probably isn't regarded as a separate good or service, so actually it's just getting amalgamated with membership. What that could mean is that whereas you're paying 100 each year for membership, your joining fee might be, let's say, 300. If your joining fee was 300 and we're saying that's not really separate, then actually you're paying 400 in year 1 for the right to use the health club, and only 100 each year thereafter. And you can see that the 100 is quite a big step down from the 400. So you then end up saying, actually, by paying this large amount in year 1, I'm entitling myself to pay less than that large amount in future years. So it seems like I have a valuable option, I have a material right to renew at less than the original amount of 400. So you would expect to spread some of that original amount over a longer period, probably based on thinking about how long people are actually going to stay in membership, or looking at it another way, at what points are they actually going to drop off.
The last topic I wanted to touch on from the additional guidance was what we in the industry commonly refer to as breakage. Amy, what can you tell us about this?
As you say, we commonly refer to this concept as breakage, but IFRS 15 refers to it as customers' unexercised rights. So, we are talking about where the customer has made a non-refundable payment that gives them the right to receive a good or service in the future. Therefore, the entity is required to stand ready to provide the good or service when the customer chooses. Sometimes, however, the customer for some reason may not exercise all of their rights. So, they've paid for a non-refundable amount for something, but ultimately they decide not to take it. And this guidance is all about when to recognise that overpayment as revenue. How an entity accounts in these circumstances basically depends on whether it is able to estimate the extent to which rights won't be taken up. If the entity can estimate this, then it recognises revenue in proportion to the pattern of exercise of the customer's rights that the entity expects. This is done by comparing the goods or services delivered to date with those expected to be delivered overall. In fact, breakage is another example of variable consideration. So, strictly, the entity will also take into account the variable consideration constraint that we discussed earlier. But the overall effect of this will probably be roughly the same as making a prudently low estimate of breakage levels. Taking a very simple example, suppose the customer is entitled to 1,000 items, but you are very confident they will only take 800. Then, when 200 items have been delivered, you will recognise 1/4 of the total revenue, i.e. 200 out of the 800 items. If, instead, the entity does not initially expect any breakage or can't estimate it, then the entity will have to determine at what point it is remote that the customer will exercise their right and recognise revenue for breakage at this point.
So this is an area where we might currently see some different industry practice. Actually, on customer loyalty programs, we probably won't see very different industry practice because, as I mentioned earlier, we already have an interpretation and that takes breakage into account. I think the challenge is going to be scenarios in which breakage arises outside of customer loyalty programs. So I would think about things like gift vouchers, where some of those are not actually redeemed. I would think about things like the travel, hospitality and leisure industry, where you have non-refundable payments being made for flights or for hotel rooms, things like that. These are areas where there wasn't previously detailed guidance, and now this new breakage guidance will actually be applicable. So that could cause a change in accounting.
It certainly sounds like there is a lot for businesses to consider going forward. We spoke earlier about transition and the 1st of January 2017 effective date. What options are there for businesses when they adopt?
IFRS 15 provides us with two alternatives, the full retrospective approach or a modified approach. The full retrospective approach broadly means that you go back and you restate your comparatives fully as if the new standard had always applied. There are some practical expedients available for this approach, and there are some special rules relating to estimates of variable consideration, but your accounts will broadly look as though you'd always been applying the standard. The simplified transitional approach means you retain your prior period comparatives, but in the year of adoption you will apply IFRS 15 retrospectively to all contracts that are uncompleted as at the date of initial application and any new contracts arising after that. There is no grandfathering of the older contracts that are still running as at the date of initial application. As under the first approach, you'll still have to work out how they would have been accounted for as if you'd always been applying this standard. The difference is just that you don't restate prior periods. Instead, you have a disconnect between the prior period and the current period, and this will be recognised as an adjustment in equity. This is one of the reasons why the transition date is not until 2017. as businesses with long-term contracts that are still in play as at the transition date will need to go and dig out the information on these contracts, and then they will need some time to work out how to get the accounting right.
The thing to remember here is even if you adopt the simplified transitional approach, you still need to produce your 2017 figures on the new basis for all ongoing contracts. And that is no matter how old those contracts are. There's no grandfathering. So really, you need to make sure that your systems can cope, and you shouldn't underestimate the logistics of tracking down and analysing information from quite old contracts.
We have certainly covered a huge amount of ground in this discussion. Thanks for your time, Amy and Phil. I'm sure everyone watching will have taken away insights to consider whether they were technical issues or considerations of systems and processes. That's all we have time for today. Thank you and goodbye.